Cholamandalam Investments' diversified business model, focus on rural-centric retail customers and stable asset quality have already been rewarded in the past few months. While there are all the ingredients for a success story, the moot question remains: is the stock a worthy bet at current levels? And in this video, we get you the answer. Chola has a clear advantage in the rural sector and has reaped the benefits of the reopening of the economy. The transportation sector witnessed a smart recovery thanks to the pickup in used commercial vehicles and tractors on the back of rural recovery, partly aided by good monsoon and harvest. Market share growth in the CV and construction equipment has been predominantly from retail customers' demand for used vehicles. Going forward, growth is expected to be on the back of higher capacity utilization by customers. Leveraging the digital way of disbursing loans, Chola is gearing up to expand its new businesses. CSEL, the unsecured piece, will grow faster, while SBPL is a unique model where lending to merchants in smaller towns might take a little longer. The loans, nevertheless, are more secured and used for business purposes. Retail SMEs, especially equipment finance, is growing at a rapid pace. With a shift in business mix, new business contributed around 16% to the total disbursement, which more than offset the minor sequential decline in the vehicle segment in the quarter gone by. Chola has a diversified funding base, including foreign borrowings and banks, where on-lending to NBFCs is now considered a part of priority sector exposure. The company raised its funding from commercial paper in Q1 FY23. It has a strong parentage of Murugappa Group and, with high fixed cost borrowing, it's relatively insulated amid rising interest rates. Moreover, the company has a focus on strengthening liquidity with a more conservative asset liability management. As far as financials go, business growth and profitability have been improving year on year with constant focus on higher yielding loan book such as affordable housing and LAP. Chola's earnings performance is marked by steady interest spreads, reasonable asset quality and lower credit cost. It witnessed substantial sequential growth in disbursement in the quarter gone by on the back of improved consumer confidence. Riding on strong domestic auto sales, the company reported best ever first quarterly disbursals, collections and profitability, albeit on a low base. The solid YOY growth in PAT was aided by expansion in NIM, lower cost-to-income ratio and controlled credit cost. The sequential decline in performance of vehicle finance was on account of higher proportion of the new vehicles. We believe, albeit the rising systemic interest rates, margins should remain steady as the company is able to pass on any rise in interest cost. Moreover, the business is shifting towards a higher yield product mix which will help the company sustain healthy profitability. Total stressed assets stood at around 12% of total gross asset. The company expects its net stage 3 to fall below 4% by the end of this fiscal. As the asset quality improves, Chola expects credit costs to be in the range of 1–1.5% for FY23, reaching pre-pandemic levels, boosting overall profitability. Chola is well equipped to deliver strong AUM growth, riding on growth in advances. The company is gradually moving towards pre-pandemic levels on the back of stable margins and benign credit costs compared to peers on improving asset quality. We believe this could translate into a sustainable ROE of around 20% across economic cycles. Also, Tier 1 capital at 16.4% versus 10% as per RBI's requirement provides adequate buffer to embark on the growth highway. The valuation at 4.9x FY24 adjusted books looks optically expensive. However, Chola's ROA profile is way higher than other asset financing companies thanks to its high-yielding book, competitive cost of funding and benign credit cost across cycles. With recovery on a firm footing, we see reasonably strong earnings and the stock performance should ideally mimic the same. Of course, like any other company, there will be some risks to watch out for. Economic slowdown impacting growth or asset quality, or pressure on margin due to high cost liability and or competitive pressure will be some risks to watch out for.